Welcome to the November update. I'm Will. I'm joined by Mike. Hey, Mike, how you doing?
Good, Will. How are you?
How was your Thanksgiving? Did you eat lots of turkey?
Yeah, I did. The whole family. I got my whole family sick, so I was the primary care provider. So just doing that. Stayed home.
Did you get them sick because of the turkey you made, or was there other reasons here?
Nah, influenza A. It's not one thing; it's something else.
Well, I'm sorry to hear that. I hope everyone's on the mend. Let's turn our attention to the month of November, which was another fantastic month in this sort of this bear market rally we're experiencing. Your first look at equities, I think trends continued here strongly from last month. So take us through the board here.
So yeah, looking at asset class performance for the month of November, all the way to the left. Another positive month, very similar to October, where it was beautiful. It was the opposite of everything we've seen year to date, right? Equities rallying and bond yields coming down. And if we go down the equity board here, what you see is, U.S. large cap equities are up 14% since October 1st. That pretty much coincides with this second bear market rally we've had. I mean, they're up about, right around 14% from their lows in mid-October. That's much smaller than the bear market rally we had in the summer, and we're still well below levels that we peaked at in the summer. But this momentum, it definitely seems like this has all the makings of bear market rally 2.0. And if you look at what's been doing well, it's been value stocks. Energy stocks have rebounded very strongly. And then we're also seeing a rebound in foreign equities. Foreign developed equities and emerging market equities are benefiting from a weaker dollar, which we can talk about why that's happening when we get into inflation and the Fed and all that. But then also China, China from the MSCI China index from its lows, and it represents a good portion of emerging markets, up almost 30%. It's been very volatile, but November was one of the best months ever for Chinese equities.
Yeah, it certainly was. And a lot of this narrative around what's driving this, there's a lot to go through and what the reasons for things like China, but we can dig into some of that later perhaps. But I think translating the equities into the fixed income space, we saw the yield curve continue to invert to probably the most inverted it's been in a long time.
Yeah, almost most inverted ever. So yeah, if we look at fixed income securities, what that means when the curve gets more inverted is longer term bond yields come down a lot more than short term bond yields. And so what you get is you see positive returns across the fixed income spectrum, but the strongest returns out, if you look at the 30-year Treasury note, up 7% from the month for the month. The 30-year Treasury peaked peak yield somewhere around 4.5% in October, and now the yield is down closer to 3.7, 3.8% as we talk here today. And if you translate that fall in long-term bond yields into a total return, the 30-year Treasury is up 12% in terms of total return since mid-October. So it begs the question: what would you rather own in this bear market rally? Would you rather own a long-term bond, a 30-year Treasury yield? Or would you rather own, something like large growth equities? Probably say the 30-year Treasury yield, because the macro outlook for that is much better. But it also speaks to the fact that it's the same stuff driving stocks and bonds at this point. It's the hopes that inflation is falling and there could be a soft landing. And, it's not what the data says, but those are the hopes.
And just so for the viewers, when the yield curve inverts to these levels and or signals, I mean, because it's sort of giving us a mixed signal. The equity markets are rallying on this bad news that the bond market is inverting to. So just maybe explain a little bit about that. Part one. Part two, we've been talking for a while about the time to invest in fixed income is coming. Is it here?
Yeah. Great question. So the first thing is the yield curve. We call it the smartest economist in the room. It's forecasted every recession since World War II with a pretty decent lead time, something like 12 to 24 months. And that's the key. it's forecasted in 12 to 24 months. It's not a great near-term indicator of recession risk, because when the yield curve inverts, what that means is anyone in the economy whose business it is to borrow at short-term interest rates and lend out money at long-term interest rates, all of a sudden they have no profit incentive. And so the credit cycle stops. And that just takes time. It's not something that, okay, yield curve is inverted overnight, the economy goes into recession. It takes time to feed through to economic growth. So this is not uncommon that you see a yield curve invert, but then you have great months in equities because, more concerned about 6 to 12 months out. What does the inverted yield curve mean for equities? So that would be the first thing. And then been talking, is it time to buy? Is it time to buy fixed income? Is it time to move out on the duration curve and overweight longer term fixed income maturities? And the answer there is almost. We're certainly getting closer to the time. What will transpire when we know it is sort of the time is we'll have a full handoff from an inflation shock to an economic growth scare. Once our recession forecast really peaks out and starts to signal, okay, a recession is imminent, which we're not there yet, thankfully. But once that happens, that will be exactly what we're looking for in our framework to say, hey, we liked fixed income. Now we really like longer maturity fixed income.
Yeah. So before we move on to the alternative space, there was a Fed speech yesterday. Jay Powell talked and gave a little Q&A after, and the markets rallied pretty hard into the last day of the month because of that. Maybe just give a few comments on what he said that shocked the equity markets higher, and what that really tells us going forward from the Fed. Because I always think about, we've always had this sort of theme inside our organization is like, don't fight the Fed. Use the Fed, work with the Fed, follow the Fed, because you will be able to make better decisions if you're following what the Fed is going to do or doing versus trying to fight it.
Yeah. Well, when we were listening to Jerome Powell speak, it was clear somebody had told him it's not what you say, it's how you say it is what matters. Because he didn't reveal any new information, but his tone was far different than the Jackson Hole speech at the end of August. And if he said anything, if you were just following his exact words, not necessarily his tone, if he said anything that was worthy of any type of rally, it would be the fact that he said a soft landing is plausible. Which, if you take that at face value, you say that doesn't mean a whole lot. Of course, it's plausible. What does that even mean? But it is key that the Fed thinks that a soft landing is possible. Because if they actually think that, then when inflation starts coming down, if we're not in recession, they might think, all right, well, this is the soft landing. We said it was possible. We can stop hiking. We've defeated inflation, right? But if they do not believe it's possible, then in that exact same situation, when inflation starts coming down, if we're not in recession, they would say, all right, well, then we need to continue to hike interest rates. Mm-hmm. The only way we're going to know that we've done enough to defeat inflation is if we have a hard landing. So that was probably the only thing that you could take away from what he said that had any semblance of, spurring a rally. Now, the magnitude of the rally we got based on what he said relative to the actual data, it doesn't mean a whole lot for us. I mean, we've looked at the probability of a soft landing, whether you're looking at the relationship between inflation and unemployment, or you're looking at inflation to job openings. And a soft landing is an extremely low probability scenario. Yeah. So it doesn't change a whole lot for us. But if you were day trading, or you have an algorithm that literally takes a transcript of what he's saying, I understand why you would cover a short position or go long.
Right. Yeah, absolutely. So let's move on to alts and look at the performance for the month. We have a little bit of a mixed bag here.
Yeah. Global REITs having a really strong month, with long-term interest rates coming down and then seeing a rally in global equities. We would expect global REITs to perform well. I mean, it's still down over 20% year to date. But then in the commodity side of things, you look at something like industrial metals, And that, once again, is what we've been monitoring very closely, is sort of, Dr. Copper is the only commodity with a PhD. These things, they're the only real source of meaningful information in commodity markets in terms of what's going on in the actual global economy. And no doubt those strong industrial metals returns that we've seen are highly correlated to expectations of how China might reopen. Um, and you know, with the protests recently and the Chinese Communist Party taking a more conciliatory tone towards those protests, coming out with new guidelines that are far more lax in terms of how they're going to deal with the COVID problem, everybody's sort of looking at that and saying, well, in the near term, China reopening is bad news for economic growth and supply chains. Because we all know what happens when Omicron gets loose in the US. Imagine what happens in China with similar levels of vaccination, but less effective vaccines. I mean, everybody's going to call off work effectively. Yeah. I mean, that's what happened to us last January, if anybody remembers. So that does nothing good for economic growth or supply chains. But if you look a year out and you look longer term, does this mean China is changing course and focusing more on economic growth and finally reprioritizing economic growth? And it probably does. And, back half of next year, our framework suggests emerging markets look more attractive because of that, but too soon. I mean, too soon to get excited.
Yeah. All right. So let's move on to one of our core investment framework guidelines, which is inflation. And let's look at the path, but then sort of the terminal level that we see through next year, and talk about how that relates to what the Fed can and can't do with respect to the sort of the terminal Fed funds rate they can achieve.
Yeah. So we'll touch on the inflation forecast first. And, this hasn't changed a whole lot. We see high and falling inflation. That was obviously confirmed by the October CPI numbers. That was the first time CPI had come in cooler than expected in a long time. And it's crazy how Jerome Powell's tone can change when you go from August Jackson Hole inflation coming in hotter than expected every single month since fall 2020 to get 1 month of cooler than expected inflation. And now all of a sudden soft landing is plausible. And we might be able to do this, right? So the data is definitely behind him when he spoke most recently. So it's still high and falling, but we've been saying over and over that's good news, bad news, right? Good news is falling, obviously. Bad news is high. I mean, out to 12 months, we're still looking at headline or core CPI running in the 5s. And that's the year over year number. Mm-hmm. So it's also important to look at the momentum here. So if you look at our expectations for the month over month, 12 months out. So what is the month over month going to be? October 2023. Those are still running at 5% plus. So that to us means, Jerome Powell, you might be able to puff your chest out right now, but your work is not done. Mm-hmm. And there's not going to be a lot of compelling evidence of inflation coming down probably for at least a few months. And then even then, you may say you're done hiking, but there's no reason why you should start cutting.
Right. Yeah. So to put it in simpler terms, the idea of a pivot coming anytime soon, forget about it. There's just no way
the
they
pivot
can.
Hopers,
Yeah, for the pivot hopers can. So don't invest on that thesis, because that's just a narrative that's false. And I think the other important thing is sort of put into context what extended periods of these rates being this high are going to do to some of these companies, these zombie companies that have existed in a low rate environment and now will be 12 months into these higher rate environments, and how that might impact labor and earnings, et cetera, going forward. So this is a newer chart. I don't think we've shown this one before. And that's sort of the expectations the market puts on where the federal funds rate will peak. And sort of take us through what this is telling us.
Yeah, this basically, it shows exactly that. For each rate hike cycle, what does the market think the Fed funds rate will peak at? And so that's the blue line. And you can see since, how you would read this, you would look at, say, May 2020. And you would look at that and say, well, over the next 5 years, that May 2020 dot, each one is the peak over the next 5 years. We expect the Fed funds rate to peak out at 0, meaning no rate hikes for 5 years. And then you can see how it took off. Immediately once, economic growth started coming in better than expected and inflation started picking up, now nobody can call the peak. You just have to keep revising up your expectations for the peak. How high is the Fed going to have to hike interest rates to finally kill inflation? And as that blue line has gone up, especially as it's gone up above the green line, and we'll explain the importance of that later.
Yeah.
Once it starts going up past the green line, that's when stocks and bond prices go down simultaneously. That's tough. And now, very recently, if you could zoom in, that's sort of the last month or two, what you see is the blue line has stopped going up. Everybody has coalesced around this idea that the Fed will be done hiking in about March of next year, that they're going to do a half a percent in December, and then 25 basis points in January, another 25 basis points in March, and that's it. Peak Fed funds rate for the cycle, 5%. Blue line stops going up. Okay, it's safe to go out and buy stocks and bonds again. And that's why you get this little bear market rally, right? But so exactly as you're speaking to, that is pivot hoppers, right? That is, in our view, the exact wrong mental model for thinking about how monetary policy actually works in the real economy. The first thing that is underappreciated is monetary policy works with a lag. Okay. If the Fed stops, even if they stopped hiking in December, the worst of the economic slowdown would be ahead of us, because the first rate hike would have been 9 months. If they stop in December, the first rate hike would have been 9 months ago. Mm-hmm. And so you could argue that all of those rate hikes have yet to even impact economic growth. So that's the first thing. Monetary policy works with a lag. And then 2, the level matters. The level is very important. That green line is the Fed's estimate of the long-term Fed funds rate. This is the closest thing to the neutral rate of interest you have. The neutral rate of interest is the level of short-term interest rates that are neither restrictive or accommodative. And so if you're above that line, that means monetary policy is restrictive. If the Fed slows the pace of hikes and only hikes 0.5%, and then only 1/4, and then only 1/4, and they stop, they are stopping at double the neutral rate. Meaning, even if they stop there and hold it, the level matters. Monetary policy will be restrictive. And the long-term effect of having short-term interest rates in restrictive territory is negative for economic growth.
Right.
Yep. So that's the other thing that's underappreciated. It's not good news that they're I mean, you could say they're slowing down. Okay, that's good. But the level matters.
Right. And the time above that level matters, right? Because it just puts more and more pressure on businesses and cost of capital, et cetera. So let's move on to liquidity. Now we got some updates to our liquidity forecast, just minor ones, but they matter. I think it's important for us to sort of talk about the current month change in liquidity, mm-hmm. and what it's telling us in our projection forward.
So after updating our models for everything the Fed did during the month of November, what you see if you zoom into our forecast horizon is less of a rebound in liquidity than we were previously estimating. So on the margin, that's obviously slightly worse in terms of our framework. And why that's happening, previously we spoke about how the Fed is supposed to reduce the size of their balance sheet by $95 billion a month by letting maturing treasuries and maturing or prepaid mortgage-backed securities roll off their balance sheet. And they had underperformed that target pretty much since they started quantitative tightening in the late spring. But November, they achieved it. They got it. They had full balance sheet runoff for the month. And so that leads us to change our expectations going forward. I mean, previously we expected they would underachieve their target for monthly quantitative tightening. And now going forward, that doesn't seem appropriate. And so we slightly revised up our expectations for how quickly they'll run off the balance sheet. One. And so that brings the liquidity line down. And then 2, the types of money that they're money, but they're not really true liquidity in the economy. Those two things came down as well. So that's specifically the Treasury General Account. For whatever reason, during the month of November, the Treasury felt it was more appropriate to draw down their account at the Fed to pay for expenditures than it was to issue new debt. So the Treasury General Account came down pretty dramatically. And then reverse repo came down slightly. And so all those things factor into money supply growth just being lower for longer than even we previously expected. So,
and again,
not
for the
exciting.
viewers, money supply growth correlates highly to equity levels.
Yeah, equity prices, particularly growth equities, low and falling liquidity environment that we're setting up for. Tough things happen. You look at what's going on in crypto. If you view that as sort of the ultimate speculative liquidity sensitive assets, no coincidence that these things are happening at the same time.
Yeah, absolutely. All right, so we're excited to talk about. Well, we're not excited to talk about recessions, but we have updated our recession model, which is pretty exciting. We've got a new factor that we've added in that really will help us sort of hone in on where we are in terms of when we might consider entering a recession or when the probabilities change. So we're going to throw this next chart up, Mike, and first explain who the Conference Board is and the LEI index.
Yeah. The Conference Board is a nonpartisan agency that focuses on forecasting peaks and troughs in the business cycle that was established in 1916. And one of the most useful things that they do is publishing the leading economic index, which is it's an aggregation of a lot of short-term and real-time economic data that they've found through their over a century trying to do this, have a really solid lead on economic activity, forecasting it about 7 months in advance. So these are things like jobless claims, manufacturing hours worked, manufacturing purchase orders, things of this nature. There are a number of other indicators under the hood. And what we found, and this supports their findings and their literature as well, is the 6-month change in the leading economic index provides a really good short to medium lead on recessions. And so that's what we're charting here. The blue line is the 6-month change in the Conference Board leading economic index. They started publishing this going back the late 50s. And you see anytime it dips below a 5% decline, that's that dashed red line, it pretty much is right at the start of a recession. So, we're always looking to improve our models. Our recession model previously contained under the hood 13 market-based economic data points and other best-in-class recession indicators. So now our recession indicator includes 14. This is another best-in-class recession indicator that adds value to our models and really helps out in that short to medium-term time period.
Yeah, it doesn't guarantee, but if you just look at this chart, every period that it has fallen below since, was it 1960 on there as a start, it's signaled recession. So perhaps talk about the levels relative to the severity of the recession. So if it just falls slightly below, does that mean an easy recession? If it falls far below, et cetera?
Well, where it is now, so it's the 6-month change is negative 6.3% annualized, which if you were to speak to the Conference Board, they would say, well, that means we're basically in recession right now.
Right.
But they would also say that that does not necessarily imply anything about the depth or the duration of the recession if it were to happen. Our point of view, the way we look at it is the economy exists in two states. There's not in recession and in recession. And once the economy enters recession, it's very difficult to say, with a tremendous amount of foresight, aside from just seeing how the data evolves, it's difficult to say how deep this one's going to be or how long it's going to be. So if clients ask us that question, we have an answer. I mean, we do a tremendous amount of research on this, but it's not necessarily built into our models. We would rather monitor the data and see when we're actually going to exit than sit here and say, oh, this is only going to be 3 months. This is going to be 6 months.
Mhm.
So
Yeah, that's it's a great addition to our model, and maybe we can throw up the recession model to look at the changed probabilities.
yep. And we're seeing similar trends to prior updates of our recession model. Still relatively low probability we're in recession right now. That's primarily due to the strength of the labor market. Although the labor market is certainly cooling, and there have been a number of hiring freezes and layoff plans announced. Those still have not bled into the monthly non-farm payroll number. We're going to see that number again tomorrow, so we'll see what ultimately happens. But the strength of the labor market is pretty much the reason why it's a relatively low probability that we're currently in recession. However, as we go out to 6, 9, 12 months, you see the probability at the 12-month point is right about the highest that it's been all year. And that is because of one particular indicator that is great at predicting recessions 12 months in advance, and that's the yield curve and the percentage of yield curve pairs that are inverted. Where over 80% of the U.S. Treasury yield curve is inverted. That's the third most inverted yield curve ever. We're actually, for the first time ever, the global bond yield curve is inverted. If you take the Barclays Global Ag Bond Index and you look at the yield on the 10-year plus and the yield on the 1 to 3 year, that's inverted. That's the first time that's ever happened. So that's probably underappreciated.
Yeah,
these things
for
aren't
sure.
just happening in the U.S. All major economies, or at least the ones that borrow money and issue debt and get put into the Barclays U.S. Global Ag Bond Index, their curves are inverted too.
Yeah, absolutely. Yeah, it's definitely an improvement to our model. We're excited that it's in there, and hopefully we will be able to time the recession entry and exit points from an investment standpoint as the data evolves. So more on that later. It's been a great month for us here at CapStrat. So we're excited for December and the holidays, and we will be back in early January for the December update. Until then, if you have any questions, always give us a call.